Welcome back to Accounting 5000. We're going to do Module 9, which is the middle part of Chapter 5. In this module, we're going to talk about two aspects of current assets. We're going to talk about accounts receivable and notes receivable. So let's start out with our discussion of accounts receivable. Accounts receivable, remember, are monies that are owed to you in the normal course of business. Customers come in, purchase things, and charge them. They will pay you later, but you've earned the money now. Typically, companies offer credit because offering credit increases sales. They know when they offer credit that not everyone will pay everything that they owe. But it's worth the risk to go ahead and offer credit because they will make enough money on the people who do pay to cover those who don't. And that's why you often have to pay such high interest charges on some of your credit cards. The people who don't pay are what we call bad debt expense. We have to write off or get rid of the accounts receivable that we're not going to collect. Well, now when companies offer credit and give people credit cards, they don't know who will not pay. They only know that some people will not pay. We have to take into account that those some people that won't pay have to be accounted for in the records. We have to show that we're not going to get everything that's been charged. So we can do that one of two ways. We can do it by looking at how much our sales were on credit and taking a percentage of those credit sales and saying, okay, that's how much we won't collect. That's called the income statement approach. Or we can look at our accounts receivable and figure out how long it's been since the account has been paid. So we take each account and say, they've paid in the last 30 days, they've paid in the last 60 days. These people haven't paid in over 3 months. The longer a debt is outstanding, the less likely it is that it will ever be collected. We call that aging accounts receivable. We look at the age of each account to see how long that account has been outstanding. The longer it's been outstanding, the less likely it is that we will collect it. We call that the balance sheet approach because we look at the accounts receivable on the balance sheet and decide which ones we think we can collect. We don't know for sure which ones we can't collect, but we can make a good estimate. Well, since we don't know exactly which accounts aren't going to be collected, we need to make an adjusting entry at the end of each cycle to show that a certain amount of our accounts receivable are not good accounts receivable. We use what we call an allowance account to do that. We call it allowance for doubtful accounts, or sometimes allowance for uncollectible accounts. And in that account we accrue, we put in monies to be used when the people actually do not pay, when it's determined that those debts will no longer be collectible. To make that adjusting entry, we debit bad debt expense and we credit the allowance account. That's our adjusting entry. That's where we set up the allowance account. It's sort of like a fund of money that we're going to be using when people don't pay their bills. As an account becomes uncollectible, as we realize who it is that's not going to pay, we take their account receivable off of the book by crediting accounts receivable and debiting the uncollectible account. So that's how we take care of uncollectible accounts. We call this writing off the account when we actually take the account receivable off of our books. We make the adjusting entry at the end of each year or each accounting cycle and put it on our books. We're going to be working some problems looking at accounts receivable and the allowance for doubtful accounts in just a minute. But I want to talk about two other things just before we do that. One is cash discounts. You may have seen this on some of the bills that you've received. There's a little code at the top of the bill and it goes something like 210N30. That's a code for meaning that if you pay within 10 days, you'll get a 2% discount. In other words, you can deduct 2% of what you owe if you pay within 10 days. The N30 means that you owe the whole thing in the next 30 days. You can see variations of that in various types of bills. Occasionally it'll be 110N30 or 310N60. The code means the percent that you'll get in a certain number of days and when the net amount or the whole amount is due. And you can subtract this from what you're going to pay. On the financial statements, if you look under net income and back all the way up to sales, you'll see that often it will have sales discounts that will be deducted from net sales. The sales discounts are these cash discounts that the seller has offered to you. So it's deducted from sales to get to net sales. Occasionally companies will use an allowance account for this to show that some people will take these discounts, but you don't see that very often in the financial statements. The last piece that I wanted to talk about before we work some problems was notes receivable. Notes receivable are related to accounts receivable in that often companies will transfer an account receivable to a note receivable. If a customer, a very good customer, is having trouble at a particular time paying a bill, they will often allow that customer to transfer their account receivable to a note receivable. Now, a note is a formal document. It's signed by both parties and it's highly enforceable in a court of law. It's much easier to collect a note receivable than it is an account receivable when you get into the legal system. And most of the time, a note receivable is backed with some collateral, which means that if the note becomes uncollectible, there is some asset that the person who owes you money will be able to give you to help pay that note off. Oftentimes when you get a house mortgage, the house is the collateral. So if you don't pay your mortgage, the company will come take the house. Instead of making you pay the note, you no longer owe the note, but you no longer have the house either. That's what collateral entails. So a note receivable often has collateral to back it up. Again, you often see this used in business when either a customer has hit some hard times and you know that it will soon be over and they'll be able to pay, or when an account receivable gets very large and you want to be able to protect yourself from that large account receivable by transferring it over to a note receivable. So those are the two topics we're going to talk about in this particular module: accounts receivable and notes receivable. So let's look at some examples that I think will help explain those two concepts. Let's start out by looking at problem 521. 521 is in your textbook on page 177, right about the middle of the page. This is an interesting one related to accounts receivable and allowance for doubtful accounts. They give you the piece of the financial statements that are on the balance sheet relating to accounts receivable. And if you notice in between those two black bars, it says accounts receivable less allowance for bad debts. The bad debt amounts are $9,500 and $17,900 respectively. That's for each of those 2 years. And then for 2004 and 2003, they have $173,200 and $236,400. Then in the required Part A, it says if $11,800 of accounts receivable were written off in 2004, what was the amount of bad debt expense recognized for the year? Well, in order to do this one, what you will need to do is to draw yourself a T account. Think about what's involved in a T account. A balance for the allowance for doubtful accounts will be a credit balance. So the beginning balance was $17,900. So in your T account, you will have $17,900 as the first line on your T account. When you add to that account, remember you debit bad debt expense and you credit the allowance account. So there I've written EXP question mark. That means we don't know that number. We don't know how much was added. However, we do know the ending balance was $9,500. Those two numbers, the $17,900 and the $9,500, came right off the balance sheet where it says accounts receivable with the write-off amounts. Now the numbers on the left are when we wrote off the accounts that were uncollectible. Remember, we debited the allowance account and we credited accounts receivable. So we know that $11,800. Now you can change this into algebraic form, as I've done down there at the bottom of the slide, by taking your $17,900 plus some unknown number and subtracting out $11,800, and that will give you $9,500. When you solve that algebraically, you will find that your expense was $3,400. Then in Part B of the question, it says the December 31st, 2004 allowance account balance includes $3,100 for a past due account that was not likely to be collected. This account has not been written off. If it had been written off, what would the effect be on working capital? Well, working capital is not going to change because all you're using in working capital is your net amount of accounts receivable less your allowance account, and they're both going to decrease at the same amount, so there will be no change. Likewise, in Part 2 there, it asks, how will it affect net income and ROI? Neither one of those will be affected because revenue and expenses aren't affected. All you're doing is debiting the account receivable and crediting the allowance account. Both of those accounts are on the balance sheet. And remember, your revenues and expenses aren't affected, and your total assets won't change. So it should have no effect on ROI. Then in Part C, it asks an interesting question. It says, what do you think the level of the company's sales were in 2004 compared to their sales in 2003? Well, a guess, based on the information they have there in your book, is that sales were lower in 2004 because their accounts receivable were substantially lower. You don't know that for sure, and you can't really tell without looking at what they collected from their accounts receivable, and you could find that out on their cash flow statement. But you would have a pretty good guess that the sales were lower in 2004 than they were in 2003. Okay, let's talk a little bit now about notes receivable, and let's use exercise 5.9 as our example for that. 5.9 is on your textbook, page 172. And I'm going to back up my slides here. If I can get this thing to work. In 5.9 it says, a company took a 10-month, 13.8% annual rate, $4,500 note from one of its customers on June the 15th. Interest is payable with the principal at maturity. Now, there are a couple of things you need to think about when you look at this problem. First, realize it's a 10-month note. It's not for an entire year. The second thing you need to note is that the annual interest rate is 13.8%. The third thing you need to note is that it was June the 15th. So realize that June the 15th is the middle of a month. Now, when we were talking about I equals PRT, we said that time was 1 year. Well, there are 12 months in a year, so we need to figure out how many months in relation to the 12 months in a year there are. So if you start with June 15th and you go until October the 31st, you'll see that's 4.5 months. So your time portion of this problem is 4.5 for the 4.5 months, divided by 12 for the whole year. Then you multiply that by the interest rate of 0.138 and times the principal amount, which is $4,500. You find that your interest is $232.88. So the journal entry would be to show that they owe you $232. So you're going to debit an asset, which is interest receivable. They owe you that. And you've earned that money, so that's revenue. And to increase a revenue, you credit the revenue account, interest revenue. In Part B, they say, okay, now let's talk about what entry you're going to make when you collect the note. Now, when you collect the note, you're not only going to get the principal amount of the note, you're going to get all of the interest, not just the interest for 4.5 months. You're going to get 10 months worth of interest. So what you need to do is to figure out how much interest am I going to get on the entire note, and how much interest am I going to actually collect that I hadn't already recorded. So let's get to that slide. We figure out first the interest on the entire note by taking 10 months over 12, which is the length of the note, times our interest rate of 0.138, times the principal amount of $4,500, And we find that our total interest for the entire 10 months is $517.50. But now remember, of that $517.50, we've already shown interest revenue of $232.88. And we're actually going to collect that receivable. They're actually going to pay us what they owe us. So we're going to credit our interest receivable $232.88. The difference between $517.50 and $232.88 is $284.62. So we're actually going to have revenue of $284 and some change. In addition, we're going to receive cash of the note amount, $4,500, plus all of the interest of $517.50. So we get cash of $5,017.50. That's going to increase our cash, and cash is an asset, so we increase it with a debit. The note receivable we no longer have. Note receivable is an asset, so to decrease an asset, we're going to credit note receivable for the face amount of the note, or $4,500. So in that problem, what we've done, we've looked at how to compute interest, how to record the note, how to record the interest that we haven't received but that we've earned, and finally how to record the interest and the note all together. Now what we're going to do in the next module is finish up Chapter 5 by looking at inventory and the inventory problems.